Hey everybody, happy Tax Talk Tuesday again. If you joined us last week, you know we started talking about the estate and gift tax and how someone that has these as an issue could reduce or even eliminate them. We're going to continue that this week, but first to remind you a little bit about what estate and gift taxes are, essentially they're transfer taxes. They are a transfer tax on wealth over an excluded or exempted amount. Under current law, each of us can transfer $11.58 million, so a whole bunch of assets, to other individuals either during our lifetime or at our passing. If we've crossed over that exemption amount during our lifetime, we're going to start paying gift taxes. And if we've crossed over that exemption amount when we pass away, we pay that tax as an estate tax. Currently, the estate tax rate is set at 40%. Meaning that if you've exceeded that $11.58 million threshold or whatever it is at the time by $1 million, you're going to pay a minimum of a $400,000 tax. Of course, there's deductions that people can take against that, but very basic math, 40% of $1 million, $400,000. It's important to note that this amount does not apply to spouses. Basically, spouses get what's known as an unlimited marital deduction, at least under current law they do. But what you may not know is that there's another unlimited deduction for estate tax purposes, the estate tax charitable deduction, and that's going to be the focus of this video. Now, last week we talked about what's known as a controlled gifting strategy, where you transfer your wealth to other individuals by staying under the annual gift tax exclusion amount. So this is a separate exclusion of $15,000 a year per person. You can also utilize those exclusions by stacking them. So a married couple can give away $30,000 to one individual, or a married couple can give up to $60,000 worth of assets to another married couple. And of course, with the exemption, the estate tax exemption amount being so high, that $11.58 million, you can even eat into that a little bit each year to use these gifting strategies to your benefit. Under the charitable deduction, though, all of that math and craziness kind of goes out the window. Putting aside any income tax considerations for a moment, from an estate and gift tax perspective, the IRS essentially says that if you don't want to pay them, you can give your money to charity. So if you're charitably inclined, this is great. It provides a simple solution to the whole complex estate tax issue. But of course, many individuals, they may have charitable inclinations, but that doesn't mean they want to give large sums of money or other assets just to charity, when that money could instead put a loved one through college, pay for a special needs family member's care, or help get children out of debt, or whatever you want to do with those assets that you've worked hard to accumulate. So a lot of people will just pay the tax, knowing that whatever's left over, 60% of that amount over the exemption is going to pass to loved ones, or basically it's going to follow your estate plan. Of course, that wasn't good enough for good old estate planning attorneys, and some savvy attorney somewhere, basically they came up with a variety of tools, or should I say trusts, that utilize the charitable deduction, that unlimited charitable deduction, while allowing some of the benefit of those assets that you've transferred to this trust to stay with you. Basically, there's a couple different ones that I wanted to focus on today. Some of the most common are what's known as the Charitable Remainder Trust and the Charitable Lead Trust. Now, we could devote an entire hour pretty much to each one of these and still have some things to talk about. But for our purposes today, I just wanted to introduce the concepts. The first charitable trust, where you are, and see my air quotes here, giving assets away, is what's known as a charitable remainder trust. And this trust saves on estate taxes because it gets assets out of your estate And you also get an income tax deduction for the year that you make the gift out of your estate. Um, but the way that these are set up is you basically retain an income stream, or somebody can retain an income stream from the assets that you've gifted to the trust. And what happens at the end after you've passed away is a charity will receive the trust assets. So there's some formulas that go into this, and basically using different tables and calculations and all of the good math that comes with this, we determine what a charitable deduction from an income tax perspective is going to be. We determine what the estate tax charitable deduction will be, and the goal would be to offset any estate taxes that are owed, because the charity is going to wind up receiving assets down the road, but you're going to have retained some kind of an income stream under the charitable remainder trust. The other type of trust, at least the most common in this area, would be what's known as a charitable lead trust. This trust is pretty much, at least on its face, the opposite of a charitable remainder trust. You're still removing assets from your estate, you're still saving on estate taxes, but when you move those assets into a charitable lead trust, the income from that trust is going to go to charity for a set period of time or until you've passed away. And once the trust terms are satisfied, the remainder interest in the trust is going to pass to your loved ones. So however you decide to build that out. Again, same idea, calculations go into play, determine what kind of a charitable deduction you can take. And if everything works out the way that we want it to, we would effectively reduce your estate tax burden. Assets further down the road are going to pass to your family, but you still have benefited charity. There's just a whole lot of factors that go into determining which one of these two trusts might make the most sense for you. That's where we come in. Our role, along with your other trusted advisors, is really to help you determine what assets it makes sense to move from your estate, whether you need a retained income stream based on other assets you may have, and how much you could potentially pass on to loved ones under some of these strategies. So if you're concerned about estate taxes and want to know if a charitable gifting strategy makes sense as part of your plan, give us a call. We can help. And as always, guys, thanks for taking the time to watch, and we'll see you again next week.